The amateur believes the professional trader has a crystal ball. They imagine a world of secret knowledge, of clairvoyant predictions about where the market will go next. But the professional knows the truth. The market is simply a battlefield of human emotion. And because human nature never changes, its expressions of fear and greed are endlessly repetitive. These repetitions create patterns, structural signatures that appear again and again at the most critical market junctures. The art of trading is not about predicting the future. It is about recognizing these proven, recurring patterns of trend exhaustion and having the discipline to act on them with a predefined plan. The masters of the market didn't guess where tops and bottoms would form. They identified the anatomy of a turn. Today, we will dissect 5 of the most powerful reversal setups known to market history. We will not just show you the patterns, we will give you the logic behind them and the exact rules for engagement, all grounded in the work of the legends who defined and mastered them. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. Our first and perhaps most powerful setup comes from the master of market structure, Richard Wyckoff. To understand this pattern, you must first adopt his core philosophy. View the entire market as the playground of a single entity he called the composite operator, or smart money. Their objective is simple: to buy from the public at the lowest possible prices and sell to the public at the highest possible prices. This means that major market reversals are rarely gentle, simple turns. They are often preceded by a deliberate, manipulative maneuver designed to mislead the herd. This maneuver, at a market bottom, is called the Wyckoff spring. Picture this scene. A stock has been in a long downtrend, but finally the selling subsides. The price begins to trade sideways, forming a clear range of support and resistance. Wyckoff called this phase accumulation. During this time, the composite operator is quietly buying shares. But to launch a new uptrend, they need to accomplish one final critical task. They must shake out any remaining weak holders and create a wave of panic selling to acquire a large line of shares at a deep discount. Here is how the trap is set. Smart money allows the price to plunge below the established support level of the trading range. This is a move of surgical precision. It's designed to trigger the stop-loss orders of anyone who correctly bought near the support. It also fools breakout traders into opening new short positions, tricking them into believing the old downtrend is resuming. Finally, it creates a moment of maximum pessimism, frightening the last few nervous holders into selling their shares in capitulation. Once this flood of sell orders has been absorbed by smart money, they quickly and aggressively drive the price right back up into the safety of the trading range. The trap is now sprung. The longs have been shaken out, the shorts are trapped in a losing position, and the composite operator now holds the shares it needs with very little remaining supply to oppose its new upward campaign. At a market top, the exact same maneuver happens in reverse. It's called an upthrust, and it's designed to trap the last of the euphoric buyers before a new downtrend begins. So, how does a professional trade this? The first thing to understand is that you never ever buy that initial break of support. That is the amateur's move, the very action the trap is designed to encourage. Instead, you wait. You watch for a precise sequence of events. First, you see the price break below the clear support level. Second, you watch for that downward move to fail. It doesn't create any significant follow-through. And third, you wait for the price to decisively climb back inside the range and close there. But even then, you don't buy. The professional's entry, the high probability trigger, comes next. It's the small, quiet pullback on low volume, where the price comes back down to test that old support level, but this time from above. That quiet test is your confirmation. It proves that the selling pressure has been completely exhausted. Your defense is just as critical. Your stop-loss has a single logical placement, just beneath the absolute low of the spring itself. This defines your risk to the dollar. And what are you aiming for? Your initial profit target is the top of the trading range where the selling first began. This framework gives you a complete professional plan, a proven setup, a precise entry trigger, a defined risk, and a logical target. Understanding these manipulations and the ability to read the intentions of large players is the cornerstone of the entire Wyckoff method. This is a deep science that extends far beyond a single pattern. To truly master this approach, it is essential to study it from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, with complete explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. While Wyckoff taught us to look for deliberate traps set by smart money, our next legend, the great Jesse Livermore, taught us to look for something more fundamental. The exact moment a trend simply runs out of energy. Livermore was a master of trend following, but his greatest profits were made when he correctly identified what he called a pivotal point, a critical juncture where a primary market trend was about to reverse. This setup is not about a single day's action. It is about observing the subtle structural shift in the balance of power between buyers and sellers. It is a classic 1-2-3 reversal, but viewed through the eyes of the master speculator. Here is the anatomy of a pivotal point at a market top. It all begins at the end of a long, powerful uptrend. The news is overwhelmingly positive, public participation is at its peak, and the market makes a final, often euphoric, high. This peak is point 1. After this climax, we see what Livermore would call a normal reaction. The price pulls back as the earliest, smartest professionals begin to take profits. This pullback establishes a temporary support level, a minor low. This is point 2. So far, everything appears normal. A healthy trend needs to breathe. Now comes the most critical phase. The market attempts to resume its uptrend, rallying from the low at point 2. But this time, something is different. The energy is gone. The buying pressure that once seemed relentless is now exhausted. The rally falters and fails to reach the previous high set at point 1. This lower high, point 3, is the first major warning sign. It is a clear signal that the primary force behind the trend is weakening. The setup is now complete, but the trigger has not yet been pulled. The final confirmation, the true pivotal point that signals it is time to act, is when the price decisively breaks below the support level created by that first reaction at point 2. This break is the verdict of the market. It confirms that the buyers have lost control and that the sellers are now the dominant force. The primary trend has officially reversed. So, let's define the rules of engagement. The professional's entry for a short position is not at the failed high. That is still an act of anticipation. The entry comes on the confirmation, the decisive break and close below the support level at point 2. This is the moment the evidence becomes undeniable. And where do you place your defense? The stop loss goes in the most logical place imaginable, just above the peak of that failed rally at point 3. If the price rises above that level, your thesis is invalidated, and the position is closed for a small, manageable loss. Your initial target is the next significant area of historical support where a previous major battle between buyers and sellers took place. This structure gives you a complete tactical plan, grounded in the observation of waning market momentum. Livermore's ability to identify these turning points was not just a technical skill, it was deeply intertwined with his understanding of crowd psychology and his own personal discipline. The full, dramatic story of how he learned these lessons through both pain and triumph is a masterclass in the mind of a trader. This entire journey, with all its psychological depth, is masterfully chronicled in Edwin Lefebvre's Reminiscences of a Stock Operator, which is presented as a fictionalized biography of Livermore. It is arguably the most important book ever written on trading, and its central theme is the brutal but necessary education in managing risk. For those who are committed to a deeper, more methodical study of these principles, we highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader. A link to this essential edition has been provided for you in the description below. From the granular bar-by-bar action of a single stock, we now zoom out to view the entire market from 30,000 feet. Our third reversal setup is not a short-term trading pattern, but a strategic economic warning signal developed by the father of technical analysis himself, Charles Dow. As the co-founder of the Wall Street Journal, Dow was not a speculator. He was a profound thinker who sought to understand the underlying health of the American economy by observing the stock market. His foundational framework, known as Dow theory, rests on a simple but powerful principle. For a market trend to be considered valid, the major market averages must confirm each other. In his time, this meant two specific indices, the Dow Jones Industrial Average and the Dow Jones Rail Average, which is now the Transportation Average. The industrials represented the great producers of the era, the companies that made physical goods. This index was a barometer of the nation's production. The rails, on the other hand, represented the companies that moved those goods from the factory to the consumer. This index was a barometer of commerce. Dow's logic was simple, elegant, and grounded in physical reality. For an economy to be truly healthy, he reasoned, companies must not only be making goods, but they must also be shipping those goods to market. Production without distribution is a sign of weakness. One without the other is unsustainable. In a healthy bull market, both averages move in harmony. The industrials will rally to a new high, and shortly after, the transports will rally to a new high to confirm the strength. This synchronized movement shows that production and commerce are in lockstep. The reversal signal, the powerful non-confirmation, occurs when this harmony breaks. Imagine a scenario where the industrial average pushes to a new record high. The newspapers celebrate and public sentiment is euphoric. But when you look at the transportation average, it has failed to follow. Its rally has stalled, creating a lower high. What is this telling you? It is one of the most powerful warning signs in all of technical analysis. It suggests that while industrial companies are still producing goods, the demand for shipping those goods is faltering. It could mean that inventories are starting to pile up in warehouses. It could mean that new orders are slowing down. It is the first visible fracture in the economic foundation of the bull market. So, how does a professional use this signal? Crucially, you do not immediately hit the sell button. A Dow theory non-confirmation is not a tactical trigger for a single trade. It is a command to make a profound strategic shift. First, you immediately stop initiating new long positions. The environment of easy, low-risk buying is officially over. Second, you tighten the protective stop losses on all of your existing long positions. Your tolerance for risk must decrease dramatically as the market is now on notice. And third, you begin to actively hunt for weakness. With the overall market showing signs of a potential reversal, you can now start to scan for individual stocks that are displaying the specific reversal patterns we've discussed, like a Wyckoff upthrust or a Livermore pivotal point. The non-confirmation is the market's early warning system. It is the distant rumble of thunder before the storm arrives, giving the prepared operator time to seek shelter and prepare for the coming change in the weather. While Dow theory gives us a strategic warning based on economic activity, our fourth setup comes from a master who believed market movements were governed by something even more fundamental: mathematical law and the immutable cycles of time. We are talking, of course, about the legendary William Delbert Gann. Gann's approach to the markets was revolutionary because it was built on a radical premise: time is more important than price. While other analysts focused on price patterns, he believed that the primary driver of all market movements was time. For him, the market was not a chaotic, random environment. It was a clockwork universe, a precisely ordered mechanism where future turning points could be calculated with mathematical certainty based on the cycles of the past. His methodology for predicting reversals was vast, but two core concepts are accessible to all traders. The first is the power of anniversary dates. Gann discovered through meticulous research that markets possess a form of memory. Significant historical highs and lows are not random points in history. They are energetic imprints in time. He found that markets have an extraordinarily high probability of reversing, accelerating, or consolidating on or around the anniversary dates of these past major turning points. A major market bottom formed 1 year ago can mark the date of a major top this year. He paid special attention to cycles of 1, 3, 5, and 7 years. The second concept is his most famous, the squaring of time and price. This occurs when a market reaches a point of perfect equilibrium, making it extremely vulnerable to a reversal. The most direct application of this is when a unit of time equals a unit of price. For example, if a stock rallies 90 points over a period of 90 trading days, or 52 points over 52 weeks, Gann would say that time and price have squared. At this moment, the forces of the trend are in perfect balance, like a spinning top at its apex just before it begins to wobble and fall. So how does a professional use these powerful but abstract concepts? This is critical. A Gann time signal is not an entry trigger. It is a signal to enter a state of maximum readiness. The process involves 2 steps. First, the professional using Gann's methods looks at the calendar before they look at the chart. They identify upcoming anniversary dates of major highs or lows. They calculate potential future dates where a current trend might square its price and time. This marks a specific danger zone or opportunity window on their calendar, a period where they must be on high alert. Step 2 comes when the market enters this pre-calculated time window. Then, and only then, do they zoom into the price chart and look for a classic price-based confirmation signal. They will look for a powerful key reversal bar, a Livermore pivotal point, or a Wyckoff upthrust. The time signal tells you when to look. The price signal tells you when to act. This 2-step process combines the predictive power of time with the reactive confirmation of price, creating a potent framework for anticipating major market turns. Understanding Gann's time-based methods requires a much deeper dive than we can cover here. It is a unique and profound way of looking at the markets. For those of you who want to explore this specific methodology further, to answer that question, we're launching William Gann Trading Insights, a dedicated channel designed to be a complete ground-up resource for studying his methods. It serves serious beginners who want a correct foundation in market structure, and experienced traders looking to add the time dimension to their analysis. We will systematically build a comprehensive end-to-end understanding of his methodology. Find the link in the video description. From the mathematical precision of Gann's time cycles, we now turn to our final setup. This one cannot be found with a calculator or drawn on a chart. It must be found in the headlines of the newspaper, in the fever of cocktail party conversations, and in the pits of public despair. It is the signal of sentiment extreme, a pattern mastered by 2 of the greatest contrarians in history, Bernard Baruch and Hetty Green. Their shared philosophy was built on a fundamental market truth. The crowd is almost always wrong at major turning points. Therefore, the most powerful reversal signal is often to do the exact opposite of what everyone else is doing at the absolute peak of their emotional conviction. The signal for a market top was best defined by Bernard Baruch. He famously said that the time to sell is when shoeshine boys give you stock tips. This wasn't an insult. It was a profound market indicator. The shoeshine boy represented the final, most uninformed layer of the public to enter the market. His participation signified that the cycle of speculation had reached a point of total saturation. When everyone, from the Wall Street professional to the man on the street, is fully invested and overwhelmingly bullish, a critical question arises. Who is left to buy? If there are no new buyers, the market can only go in one direction, down. In modern times, this same signal appears as magazine covers proclaiming a new era, taxi drivers boasting of their crypto profits, or celebrities endorsing speculative assets. The rule for using this signal is a lesson in discipline. When you see these signs of widespread irrational euphoria, you do not try to squeeze out the last 10% of the move. You begin to systematically sell your positions into the market's strength. As Baruch wisely stated, "I made my money by selling too soon." You exit the market while the selling is good, preserving your capital while others are consumed by greed. The signal for a market bottom was mastered by Hetty Green, the Witch of Wall Street. Her strategy was the perfect mirror image of Baruch's. Her guiding principle was to buy when there is blood in the streets. This signal appears when market sentiment has reached the point of total capitulation. It is visible in newspaper headlines proclaiming the end of financial markets, in widespread bankruptcies, and in a public mood of utter despair, where the very idea of buying a stock is considered an act of insanity. This is the point of maximum pessimism. It is the moment when the last terrified seller has thrown in the towel. And it is precisely at this moment that the Contrarian, armed with capital and courage, begins to act. The rule here is to begin carefully accumulating high-quality, fundamentally sound assets that are being discarded for prices far below their intrinsic value. You're not trying to catch the exact bottom tick. You're buying into a zone of maximum opportunity, knowing that fear, like greed, is a temporary emotion. So, from the intricate traps of Wyckoff to the structural breaks of Livermore, from the economic warnings of Dow to the mathematical cycles of Gann, and finally, to the psychological alarms of Baruch and Green, what is the common thread? These 5 setups, while different in their application, all teach us the same universal truth. Market reversals are not random, unknowable events. They are the logical conclusion of observable processes. Processes that unfold in price, in time, and most importantly, in the predictable waves of human psychology. Your task as a developing professional is not to invent new secrets, but to master the recognition of these timeless patterns. The mastery lies in developing the patience to wait for these high-probability setups to appear, and cultivating the iron-willed discipline to act on them with a clear, unwavering plan when they do. That is the true art of spotting the turn.